Welcome to another episode of our podcast. I'm your host, Connor.
And I'm your other host, Jake. And today we're going to be talking with someone from our SLP Wealth team. His name's Logan Foltz, and he is a tax manager. And today we're going to be talking about buying equipment and depreciating equipment and other things that you can depreciate within your practice. Or if you don't own a dental practice, other things you can depreciate as a 1099 associate that you might not have thought about in the past. But we'll talk about how exactly depreciation works. And just to give Logan a little bit of an intro here, he is a former practicing physician, and he decided healthcare was just too boring for him, or not boring enough for him, is what I should say. So he wanted to move over to be a tax professional because that is just the right amount of boring compared to being a physician.
Well, you know what's not boring, Jake? It's taking call every fifth night and also working 2 Saturdays every month. I excel in doing tax returns is just the Goldilocks level of boring for me, and I think I found my place.
Yeah, there you go. So we are so excited to have Logan on the pod today, so as we were kind of talking before this podcast, we were trying to think of things that in our personal lives that we had bought that was extravagant, because we were thinking about, as business owners, we kind of hear that kind of nomenclature of like, hey, just write it off. Whatever you're buying for your business, just write it off. It could be like, if you're a landscaper, for example, you could buy a big truck, write it off, right? Because that's a tax savings, right? So, and so it's funny because we're all financial professionals here, and we're like, man, like I'm pretty frugal because my financial plan warrants me saving a ton of money to get to where we want, right? So, so Connor, thinking about what's the most recent thing that you bought that you'd considered extravagant in your life?
Oh man, extravagant. I'm a pretty frugal person generally. I'm cheap probably to a fault. The best thing I can think of is, you guys have like guilty pleasure movies?
Little bit.
Yeah. Okay.
Yeah.
So
Scary movies for me.
yes. Okay, great. So it's cooling down a little bit in Chicago. There's like a chill in the air. It's almost like Halloween time. And my wife and I, our guilty pleasure movie around Halloween time is Resident Evil. So we bought them on Apple TV, digital box set.
Yeah. Wow, I gotta loosen the purse strings a little, because I still watch my horror movies on the free TV apps like the Roku app, but it sounds like that's maybe a worthy extravagance.
$70 for movies, I would say so. It like kills me to like rent a movie for like $9 on Amazon. I'm like, but I really wanted to see this, but but it's totally worth it, in the end of the movies.
But the first thing that comes to mind is, like, a year ago, I relocated across the country, and I was a firm disciple of, and this will touch on something we'll talk about later, but with just buying a beater car, driving until the wheels fall off, and not throwing money away on a new vehicle. And so I had a 2008 Honda Civic at that point. Only had 170,000 miles, but I had to rent a moving truck, and I was thinking, well, do I really want to spend $2,000 transporting this 15-year-old Civic across the country? And so I caved and went to CarMax, sold it, and bought a new EV, and also got the tax credit for it. So that I guess detracts a little bit from the extravagant part of the expense, but yeah, I mean, it was worth over 10 times what my ancient Honda Civic is worth. So I would say it was a big upgrade.
And it wasn't worth it.
Like and I also don't miss paying for gas. So I don't even look at the signs that as I pass them on the road anymore.
I have recently relocated as well, and I consider my extravagant purchase the cost of my rental house that I'm currently renting, which has doubled my housing cost. And so to me, it's totally worth it. The amount of space, the new location, just a huge lifestyle improvement. And so that's, like I said, we're all pretty frugal as financial planners. You're not going to see us go into a bunch of credit card debt or anything like that to buy things that are extravagant. But yeah, I would consider that my most extravagant purchase, in quotes, right? Because I'm renting it. But yeah,
I love that. There's quality of life that goes along with that, though.
that's right.
Great.
Yeah, that's one of the best ways to be to spend your money in ways that aren't necessarily frugal, things that increase your quality of life.
That's right. So let's talk today about a dentist's quality of life and their practice, or as an associate in their business. So Connor, you watch a little bit of Schitt's Creek, right?
Yeah, yeah. You were saying like just write it off. That made me think of it. Uh,
Yeah.
yeah, that's the message, right? Like David opens up his like his shop and he says, "Oh, I'll just write it off," right? And he
Yeah.
thinks like it just disappears. It's just gone. Not
I'm not, I
exactly.
don't have to pay for it. We just write it off.
So I
Yeah,
haven't seen that
yeah.
show. Is they basically just think all everything they buy is free because they can just write it off?
Yeah, it's a really wealthy family's fall from grace, and they're kids who are very like sheltered and don't know how the world works. One of them starts a business and just thinks, "Hey, I've heard this phrase, write it off." It just means it disappears, right? And then the parents have to educate them what that actually means. Yeah, I think we're talking about like, maybe if you just purchased a practice or, if you're 1099, like what does writing it off mean? What are the options available to you? And, if you need to buy a new like handset, what does that mean? Or a new chair? Can you expense the whole thing? Do you depreciate it? You've probably heard those terms before. So yeah, I guess. But before we even get into that though, Logan, do you have any thoughts before we talk about, buying things?
Yeah. Well, that's something that a lot of people that are just getting into work, being self-employed, working as an associate or being a practice owner, it's a novel concept to them because if they were working as an employee before, then either they could get reimbursed for equipment they buy or expenses they make, or they could just eat it. They don't get to deduct on their taxes at all. And so it's really exciting when you start working for yourself and realize that gosh, I need to buy all this stuff anyway. And now I can deduct it. Now I can use it to lower my taxes. But there's a lot of complexity to that. And the amount you can deduct and how much the deduction is worth, that depends on a lot of things that are specific to your situation.
So before we dive into that conversation, um, how do you feel about, I mean, is there, when you just purchased a practice or you're, let's say, working as a 1099 associate where you need to do some accounting, are there any general guidelines, anything you would suggest, Logan?
Well, I think the most important thing is that you have a system that tracks your expenses so that Uncle Sam will give you credit for them and you don't miss something. When either you're filing your taxes or your tax professional works on that because they will if you're either you go in the software and you'll have to list all the expenses you have or the totals for each category of expenses, or you'll need to submit that list to your friendly CPA or enrolled agent. And if you don't keep track of that in real time, then there's a good chance that you will just cost yourself money when it's time to file your taxes, because you can imagine if you forget about $1,000 CAV course or CE course, and that's a chance to lower your income by $1,000, and that's several $100s you would save in taxes right there. So the most important thing is that at the end of the year how much you spent on business expenses. And the benefit of bookkeeping software using a bookkeeper is they can save you time and potential costs for the tax preparation, because they can kind of summarize and categorize all the different expenses, and also help you ensure that you get the maximum deduction that you qualify for. So I think that the right system for you depends on a few things. One, how organized you are, and two, how complex is your income and expenses. If they are on the more complex side of the spectrum, then you may want to hire a bookkeeping service. But even if you're an associate, just someone working 1099, then I think for most people, some kind of bookkeeping software like QuickBooks Self-Employed, which isn't that expensive, is worth the investment, just so you have everything organized and you have a complete list of your expenses.
And if you're a 1099 associate, I would say keeping everything on one credit card would be very helpful from an organization standpoint, right? And then with QuickBooks Self-Employed, you can link your credit card to
Mhm.
the software, and so you don't have to do a whole lot of manual organization at that point, because it kind of learns what category certain expenses are in. Now, I wouldn't kind of put 100% trust into that, so I would trust but verify. But that could save you a lot of time in the long run. Because Logan, you would know best preparing and planning taxes for a lot of our clients. But we've definitely worked with clients that used an Excel workbook of just listing all of their expenses out, and then there's not really a lot of detail around them. And they're like, oh, I think that this is for this back in February, and it just creates a
Yeah.
lot of chaos.
Yeah, and you want to have like a record to fall back on, because if you start just listing round numbers, like I spent, $4,000 on supplies or something, and it's a lot of round numbers, then that raises your risk of being audited. It's pretty obvious that those aren't exact. But if you're doing just an Excel sheet, like you mentioned, it's all manual and potentially tedious. I know this from experience because I was working in locum tenens as a physician. It was pretty simple, but I was a big, travel hacker, credit card maximizer. And so I've had my expenses on about 8 different credit cards, which seemed like a good idea at the time because it got me like a lot of Chase points, American Express points. But I definitely wish I had just one business credit card when I was doing that, because it would have taken, instead of 3 hours, it would have taken 15 minutes.
So we talk about this D word, depreciation, and I think a lot, like we said, just write it off, like from Schitt's Creek. But just Logan, just in your terms, if you could just simplify that word as much as possible,
Mhm.
what does depreciation mean to you, other than it being a word we use in Scrabble? So like
Yeah.
really, it's like a 60-point word in Scrabble, I think, or something like that. So
Yeah.
so
Well, I hope I would get that if I had those letters, because
yeah.
I'd use that word a lot. Depreciation just means that that expensive things that you buy are wearing out and losing value. And so a lot of the things that you would purchase as a dentist are eligible for depreciation, but not everything can be depreciated. First of all, you can't, like, when I think of something that's like wearing out and getting slow, I think of myself, but you can't depreciate yourself. You have to depreciate something you buy, or something like physical, generally. Instead of taking the whole cost of something and deducting it up front, which you can do for a lot of business expenses, the IRS says that you can only deduct a certain amount based on how much that item has lost value, because there's just guardrails in place for just how much you can deduct for something expensive at a time. And so the guardrails are basically the depreciation rules, which we can talk more about.
Basically, it is a way for someone to account for large purchases, but I think it's spread out over time instead of expensing it all in one year,
Yeah, that's
basically.
right. That's right.
Okay.
Yeah. A lot of people are probably familiar with depreciation from just some things that they own, just personally, not as business owners. Everybody knows that, the day you drive your car off the parking lot, it goes down several $1,000s in value. And that's basically depreciation. The IRS has specific ways that they want you to calculate it, based on how long they say that certain items take to depreciate. But that's how you account for the expense over time. It's basically you deduct it in the year that the IRS says the value went down, rather than just all up front.
Now, Logan, you're saying so there's schedules that you have to abide by, right?
Mm-hmm.
Depreciation schedules. Is there, let's say like I'm a new practice owner and I have some equipment. I want to buy like a CBCT machine, because my practice needs one, or I want to do, I want to have the functionality. Uh, you know, what choices do I have there? Is there any leeway as to like depreciation schedules I choose, or different ways to depreciate?
For most things, the depreciation, like, I know that there's like a lot of changes that have happened with the tax code the last few years. Depreciation, well, I guess the main one is bonus depreciation, but let's just stick with regular depreciation. The type of schedule you follow, it's really pretty set, by the IRS. It just depends on the type of equipment it is, or the type of thing you're depreciating. So there are some things that you depreciate over 5 years. There are some things that you depreciate over 7 years. There's some things you depreciate over 15 years, 20 years, and it goes on. Most things that a dentist would think about deducting over time that would fall into depreciation category would be a 5-year thing, and that's equipment, machinery, anything with a motor. Also, vehicles, which we might talk about later, are a 5-year item. That's kind of the baseline, is you just depreciate over 5 years. And sometimes you depreciate the same amount every year, like you would depreciate, um, you know, like
So let
1/10 for 10 years. But if it's some of the shorter things, you depreciate more up front, as because the item loses, like whatever you depreciate, it's going down in value faster than it would be towards the end of the life of whatever it is you're depreciating.
So for example, let's say they buy a CBCT machine and it's $80,000 just to make it
Yeah,
round, and it's a 5-year depreciation straight line schedule. That would mean about $16,000 per year would
yeah,
be counted as like a business expense
yeah.
against their income.
Yeah, so let me provide a little bit more context to that. So the type of depreciation schedule you have kind of depends on the class of property and the depreciation life. If it's 5 years, then you're required basically to do the declining balance method, which means you take more upfront. I think maybe 40% the first year, and then it goes down year by year and tapers off. So if you buy an $80,000 CBCT machine, then you would deduct a large portion of that the first year, and then it would go down a little bit each year until the whole $80,000 is deducted through depreciation over that 5 year period. That's just if you do the regular depreciation. Like for some things that are longer, like that you would deduct over more than 20 years, you would use straight line depreciation, which means taking the same deduction every year. So that's just if you just don't do anything special like bonus depreciation.
For that practice owner that buys the CBCT, let's stick with the numbers that Jake brought up. Are there any other options or anything that they can take advantage of, or should they, I guess like when you're making that decision, how should they think about that from an accounting perspective and how that's going to impact
Yeah.
their practice?
Is there any discretion in
Right.
terms of how much you can depreciate?
Yeah, so this is where some recent changes in tax law have created a few different options for what you can do. A few concepts that I'll mention without like getting into calculations and numbers. When you do depreciation, there's also a convention for when you start the depreciation. So actually, the first year that you take depreciation, you only be deducting for the first 6 months for something that's like dental equipment, and it's a little bit different for real estate, but it's a half year convention schedule. So you would deduct a lot up front, but it would only start about halfway through the year, no matter what time of year you bought the equipment. So that's just how it works most of the time. But there's a couple of different options available that you can use to take even more depreciation up front. And so um, they're kind of similar in some ways, but different in others. So one is Section 179, which means that you can, in some cases, deduct 100% of your business use up front for something. So let's say you buy the $80,000 CBCT machine. If it's 100% used for business, and if all the other conditions are met, you could deduct $80,000 in the first year, actually. So that could be really valuable as a deduction up front if that's what you want to do. And then there's something that the Tax Cuts and Jobs Act introduced called bonus depreciation, which allows you to deduct in 2024 up to 60% of the business cost up front. And so you might say, well, why would I do one or the other? And you might be able to do both, actually, or one, or I mean, either, I should say. But there is that limit of 60% for 2024 in bonus depreciation. And there's some other limitations that we could get into, but it can be a little bit nuanced about like which one works best for which person. But bottom line, you can deduct more upfront if you choose one of those options.
This provides a little bit of a tax minimization strategy when we're talking about projecting out high income years, high profit years, or maybe year like on the up. You could have a high profit in two ways, right? So revenue grows more than expected, or expenses are less
Yeah,
than, so it's like maybe the staff, you plan on hiring more staff next year. So it would make more sense, to
yeah,
depreciate it this year because there's going to be less other expenses that you can deduct, right? In your tax planning meetings, like how do you, like, uh, we're kind of thinking about that question, when should I buy this equipment? If there is a little bit of discretion and they don't necessarily need it right now in operations, or they can get by without it right now.
Hmm.
Like, how do you think about that conversation?
Yeah. Well, as a tax manager, my scope's a little bit more narrow than your perspective and Connor's as financial planners, because I'm not thinking so much about the cash flow and how much cash is available. I kind of think about what's the way to get the biggest tax advantage from the equipment, or the
Mhm.
purchases you need to make or any business expenses. So one thing I think about is, what is this dentist paying in taxes this year, like their marginal tax rate?
Mhm.
And there's different components to that. There is, the regular income tax, but there's also potentially self-employment tax, which can be like up to 15% if you're
Mhm.
still paying for Social Security. And if we're thinking about like when is it best to deduct more upfront to take more depreciation, I think about, well, what's their tax rate this year, and what is it going to be in future years? Do we know? Can we predict it? And for a lot of clients, it's going up. Their income's going up, their taxes are going up. So there's a tax advantage in extending depreciation, but not always. I mean, sometimes there's just a really, there's just a big, a big infusion of money coming in from either their practice or from their spouse's job, or just from other places. And so that might be someone who wants to take a bigger deduction up front.
Mhm.
And they also might just want to do it because they have something temporary going on. Maybe they're expecting student loan forgiveness in a couple of years, and so they really want to get their payment down this year because they'll save 10% on their student loan payments this year. But that wouldn't be a consideration in future years. So um, for most clients, I'm discussing with them, well, is it better to take the more of the depreciation up front to do bonus depreciation or a 179 expense, or just to defer it, just go by the regular depreciation schedule? For most of our clients that are kind of haven't been out of school too long and are just getting started, expect their income to go up, I usually say the bonus depreciation and the 179 deduction, it's helpful in the short term, but in the long term, it's probably not worth it.
Yeah.
So yeah, and similarly, like if a client is thinking about like buying an expensive machine or a drill or something, and they could buy it November of this year or February of the next year, well, I'll say, well, let's see how much you pay in taxes on every dollar you earn right now. Let's see what it might look like next year. And we go through all
Yep.
those numbers and generate their tax forms and kind of see what the differences are.
Because you're
Yeah.
saying, Logan, if you buy it in November of this year, you get the full year of depreciation next year, or you could possibly write off the whole thing this year, right?
Yeah,
Is that
that's
what you're?
possible. Yeah, I mean, if you buy it November of this year, you could still take the bonus depreciation or the 179 expense in 2024, and the same for 2025. If you're just doing regular depreciation, it doesn't matter so much because it would only be a few months difference. But that's just how I think about business expenses in general. If there's some discretion on the timing.
That's
Yeah.
really neat to think about. I'm curious what you think on this. Like a practice owner who's, let's say you're a couple years in, you have a practice loan, but you know that practice loan is gone in, let's say, like 3 years, right? And you have this thing that you can depreciate over 5 or 7 or 10 years. Um, but you know that 7,000 of deductible practice loan interest disappears in a couple years here. Income, net profit from the business, at least on the books, is gonna look a whole lot better. Maybe maybe that would be a case where you would push out the depreciation. You would elect not to take these special programs, not take 179 or bonus depreciation. You'd stretch it as long as you could because that deduction is worth more to you later at that point, right?
Yeah, yeah, I 100% agree, and I think this is really where good tax planning comes into play for a practice owner. It's like,
Mhm.
okay, what does your growth trajectory look like? Because your growth trajectory, your profit, realized in like in your case, year 4, year 5, year 6, maybe after the practice loan is paid off, is going to surpass what your interest deduction was on your practice loan. Maybe it still makes sense to speed up the depreciation, or something like that, So,
Yeah.
so I think we have to we can't just kind of look at like this year in the face and say like we got to do everything we can to minimize taxes this year. And I think just even in personal finance in general, for just like our clients for on their personal side of things, we want to try to minimize lifetime taxes, not necessarily this year, because usually, and Logan, you might be able to speak to this. Usually it's kind of like whatever you deduct this year, you have to pay eventually in future years. And
Most of the time, yeah, that's true. Yeah. There's some ways you can kind of defer paying taxes on things you own, for a long time, but generally that's true, especially with what we're talking about with depreciation, because that alludes to something I meant to touch on earlier, which is that if if you take a lot of depreciation up front, then there's a chance you could have to pay it back in taxes, especially if you don't hold the item long, like if you don't hold the machine for long term and you sell it. Well, if you took, let's say you took that $80,000 machine, you deducted all $80,000. If you sell it for $40,000, does that mean you just get to keep it all? No, it means you have to pay tax on the amount that you sold it for, which you wouldn't have had to do if you did not take that depreciation up front. So that's just the
yeah,
calculated risk you take when you take a lot of depreciation up front. You're basically making a deal that you're either going to use it for the whole time that you're supposed to use it, or you're going to pay back the amount that you get back for it if you were to sell it.
and that's even worse of a case when the asset's appreciating and not
Mm-hmm.
declining in value, such as real estate,
Mm-hmm.
typically. So a lot of our clients that are practice owners also own the commercial building that their practice is in. And so can you
Yeah.
speak a little bit to like that whole recapture process for like a commercially held uh
Yeah,
practice?
absolutely. Yeah. So real estate's a little bit different because you can't actually take a 179 deduction or a bonus depreciation on real estate. I know you can't use on something that depreciates over more than 20 years. So basically, you can't do it with real estate. So you're taking straight line depreciation on the practice building. And it's a pretty long time. I mean, you might be kind of dismayed or frustrated, and you see that it takes 39 years to get the whole value deducted on your tax return, but that's just kind of the way the rules are.
So,
But anyway, when you sell it, like let's say you own that building for 10 years and depreciate $50,000. Well, if you sell it for more later, then you'll recapture the terms recapture. You'll have to pay taxes on the amount that you depreciated previously. And if it goes up in value even more, beyond that, then you'd also pay taxes on that, but it's at a lower rate. It's the capital gains tax, which is lower than the regular income tax rate.
And all along the way, you still get to deduct your mortgage interest, right? For that property, if you
Absolutely,
if
yeah,
you have a loan
yeah,
against it. Okay.
yeah. That's business interest, so you definitely can deduct that.
Okay.
yeah. So
Mhm.
so think about really long term here for somebody that just acquired a practice and the building. Typically what we see, and we don't work with a ton of dentists that are selling a practice. Most of the clients we work with are purchasing a practice. But fast forward to the year of a sale, and they sell both the practice and the commercial real estate. And the commercial real estate has the depreciation recapture at an ordinary income tax rate, right? And then the capital gains above and beyond the
Mhm.
purchase price, and then capital gains on the difference between the cost basis in their practice versus the value of the practice.
And
And
I
so
I was gonna
so
say,
think
I hope that client is working with a very skilled and excellent planner like you, who's been tax
yeah,
loss harvesting for 25 years,
yes.
so they could save on those capital gains taxes. But yeah, that's a real possibility. If they hold it for a long time.
Yeah.
Um, but it's not all doom and gloom. One thing that is helpful to keep in mind, like I said, long-term capital gains rates are not as high. Like for most people, right now, the tax rate 15%. So it's not something just to forget about, but it's not like you're paying, 37%, which is the highest income tax rate right now. And also what's kind of cool, and this is probably because we have a lot of um, real estate people I won't mention in government, but if it, when you recapture real estate depreciation, it's not actually taxed up to the highest tax rate. The maximum is 25%. So
Okay.
in theory, you could depreciate and deduct, the depreciation at 37%, which is the highest tax rate now, and only recapture it at up to 25%.
Oh,
So that's one way you can kind of just get yeah, like get an advantage by doing that. But that's only for real estate. It's not for dental equipment or other stuff like that.
That's good to know. I know I think we have quite a few practice owners who've bought a practice from somebody who retained the commercial real estate, maybe because they were afraid of that exact thing, that they probably got a bill from their accountant like, here's how much depreciation you've taken over the years, and if you sell it, here's your tax bill, or just hold it and get some income. So
Yeah. Yeah. And you do need to track that depreciation over time. But fortunately, if you're getting your tax returns prepared professionally, they should be using what's called a depreciation schedule to make a note of just how much depreciation has been taken on long term for that property. Isn't depreciation fun?
well, I appreciate that you're explaining it to us. I've got to ask, I know we're coming to our end here, Logan. I want to ask, writing off your car. We talked to a lot of folks. I think Jake, you can attest to this too, that 1099 associates, or you own a practice and you'd like to expense as much of your car, personal or a business, specific car, expense as much of it as you possibly can, or get your biggest tax benefit there. Are there any things to avoid, any pitfalls to be cautious of?
Yeah, I mean, the main thing is not trying to deduct vehicle expenses that aren't business expenses. So you can deduct business expenses on your business return, but you can't deduct personal expenses, which would include personal use of a vehicle on your tax return in general, but not your business part of the return. So that's kind of the headline. But then the question is, how do you tell the difference? Well, first of all, unless you have a vehicle that you're only using for business purposes, that you're not using to go to your kids'
Target.
soccer games or go mountain biking or go to Target, then if that's the case, then you don't have a vehicle that's you can deduct all the costs for, because you're using it for personal reasons and possibly business reasons. Some reels or something that say, here's how to deduct 100% of your vehicle, but just be aware that that's for a pretty specific situation. It wouldn't really work unless you have multiple vehicles. So that's probably the simplest pitfall I would mention right now. Also, you have to think about, what does business use of a vehicle describe? So you can't deduct your commute if you live at home and work in a different place. That's your commute. Generally, you cannot deduct that. I'm not saying it's fair or anything, but that's considered like not business mileage. So then, like, what is business mileage? Well, that's if you go from one place of business to another, like if you work in more than one office. You can even deduct business miles if you set up your home as a place of business to another place of business, like an office. So that is deductible as well. And that's where the home office deduction, which we could probably talk about some other time, can really help you increase your business expenses and deductions. So that's business mileage also. And if you're traveling out of town, like if you're doing a temporary assignment and it's outside of where you live, then you can deduct that also. That'd be business use of your vehicle. And there's a mileage rate which you can use to calculate how much that is. And you have a choice between that and deducting the actual expenses, which would be everything from fuel, from depreciation, which we've talked about, to repairs, to cleaning, to all those things. And which one you want to choose kind of depends on mainly what kind of vehicle you have. Like my 2008 Honda Civic, there was no way that the fuel costs and like the repair costs and insurance costs were going to add up to as much as the IRS would give me for just deducting based on mileage. But if you have like a G-Wagon, that's going to be different, because you're going to have a lot more your vehicle expenses than you would if you're driving a beater.
Yeah. So just to kind of summarize my take on this is, if you're planning to deduct your entire expense of your car, chances are you probably can't. Now, this is not tax advice or anything, but I wouldn't just put one item in your bookkeeping there of, hey, this is how much my car loan is every month, or my lease payment is every month. You have to keep record of where you're going, how, what percent of your total car use. There's just a lot of intricacies, and the more detail you have, the better the tax preparer is going to be able to justify either it's a business expense or it's for personal use.
And this, like you said, this is very intricate and convoluted, like what's business miles and what's not. I tried to give you just the high level overview, but either you can read publication 463 for yourself and try to learn this, or if that just makes your head hurt, like does most people, it's probably a good idea to work with the tax manager, because they can tell you, this is the mileage you can deduct, this is what you can't. And then the best thing is to use an app. where you just swipe one way or swipe the other if it's a business trip or if it's not. And then your tax professional, they can tell you, this is the percentage of your driving this year that was business, and this is what you can deduct. Or you can deduct this much based on this much business miles. You very rarely can someone deduct 100% of their lease payments or the purchasing price of their vehicle. It would have to be 100% business use. So you probably just want to learn more about that and not just go by what you hear on TikTok.
Is it Reels or TikTok?
It's neither of the above. Yeah, like I've kind of aged out of social media except for the really old school platforms. But yeah, either one. I think that's where I've heard people say they got it from.
But if you put an operatory in your house, it does. So maybe that's the new strategy, right?
That's
Because then
actually
it's office to office.
Yeah, I mean that is a really valuable loophole, but you do need it does have to be like a bona fide business use of your home for that to work. You can't just say that my nurse calls me or my assistant calls me with a test result or something like that. You have to actually use it as a place of business.
That's good to know.
Mm-hmm.
Good to know. Thank you for regrounding me. I thought I had something there.
Yeah.
Well, I think that about wraps us up. I think we covered a heck of a lot here. I mean, we covered like how to buy property and different tools that you can use, Section 179 and bonus depreciation, whether to depreciate in an aggressive way or not. We covered a lot of ground here.
We did. And one final question, Logan, does depreciation lower your AGI?
So if you take depreciation, it will lower your AGI by lowering your business income.
So for student loan borrowers out there that want a tool to lower AGI and they're thinking about which year to purchase equipment and which schedule of depreciation to use, ask your CPA about, hey, what can I do to lower my AGI and lower my student loan payment in this year so I can use this tax return to lower to when I recertify my income? That's going to be a key tool, as well as your retirement account contributions and other business expenses there. So just keep that in mind.
Yeah, I've had some clients, basically have $0 payments because they don't have any business income, and that's because they took depreciation aggressively.
Really good call out. Yeah, thanks, Jake. Cool. Well, I appreciate you joining us today, Logan. Thanks for putting up with our.
Yeah, well, it's okay. It's probably warranted, but yeah, it was fun hanging out with you guys.
Yeah, I got a feeling this won't be our only podcast together, so looking forward to the next one with you.
Yeah. Let's dive in and get nerdy about taxes.
All right. Thanks everybody for tuning in. We'll see you in the next one. If you have questions about what we covered in the episode, you can schedule an onboarding meeting with a planner on the SLP Wealth Dental team at slpwealth.com/book. This podcast is for informational and educational purposes only and should not be considered individualized financial advice. If a specific investment is mentioned, it should not be considered a recommendation or endorsement to buy or sell the investment. You are encouraged to seek the advice of a financial professional before implementing any investment strategies discussed. All investments involve risk. Past performance does not guarantee future results.